The importance of asset allocation for retirement investing. You're 60 years old, ready to retire, and then, boom, the stock market tanks. Half of your savings gone overnight. What do? Keep working? Cut back on your dream lifestyle? This nightmare is real for many retirees who didn't plan their investments wisely. But here's the good news. You can avoid this fate if you master one crucial strategy: asset allocation. And if you think this is something you can figure out later, let me ask you, how much of your money are you okay with losing just because you waited too long? Stick with me, because by the end of this video, you'll know exactly how to structure your investments for long-term wealth and security. 1. What is asset allocation and why? It's the backbone of wealth. Think of your investments like a well-balanced meal. Would you survive eating only burgers for a year? Sure, but you'd regret it. Asset allocation is your financial diet. It ensures you're not relying on just one type of investment. The goal? Balance risk and reward. Some assets grow fast but are risky. Others are stable but slow. The right mix? That's where the magic happens. But how do you get it right? That brings us to 2. The biggest mistake young investors make. If you're in your 20s or 30s, you've got a huge advantage: time. But most young investors waste it by either going all in on risky investments, hello crypto bros, playing it too safe and earning next to nothing. The key? A strategy, one that grows your money while protecting it from disasters. Speaking of disasters, what if I told you that even a 1% change in your investment approach could mean an extra 6 figures in retirement? Let's talk about how. The solution, building the strategy 3. How to choose the right mix without guessing. A futuristic AI tool generating a customized investment plan for different people. Here's where most people get stuck. Should you go 80% stocks, 20% bonds, or 60-40? What about real estate? The answer? It depends on you. If you're in your 20s, you can afford more risk. So 80% stocks, 20% bonds might be your best bet. If you're in your 30s, you might want to start balancing out with some real estate or index funds. Here's a fun way to remember. Think of investing like dating. You need some excitement, stocks, and some stability, bonds, real estate. But go all in on excitement, you'll get burned. Would you rather have a steady millionaire retirement or be the person saying, I almost got rich on Dogecoin at 60? Thought so, but even the best investment mix won't save you if you ignore this next crucial step. The secret weapon, rebalancing. Imagine riding a bicycle without ever adjusting the handlebars. You'd crash, right? That's what happens if you set your investments and never rebalance. Markets shift. What was 80-20 last year might now be 90-10. That's dangerous. Rebalancing keeps your risk in check and locks in gains from high-performing investments. And speaking of gains, how do you maximize returns without taking crazy risks? This next strategy is something even seasoned investors overlook. The payoff, achieving financial freedom 5, the 4-bucket system for stress-free retirement. You've just retired, and instead of stressing about market crashes, you're traveling, enjoying life. How? By using the 4-bucket system: growth bucket, stocks and high-growth assets for long-term gains; stable bucket, bonds and real estate to balance out volatility; income bucket, dividend stocks and rental income for passive cash flow; cash bucket, emergency funds to cover 2 to 3 years of expenses. This strategy ensures that even if the market tanks tomorrow, you have cash to live on without selling investments at a loss. Which sounds better? Panicking in a market crash or sipping a margarita, knowing your finances are secure? Now the biggest question, how much money do you actually need to retire? The answer might shock you. 6. How much do you need to retire comfortably? Most people have no idea how much they need, and they end up either working forever or running out of money too soon. Here's the rule. Multiply your annual expenses by 25. If you need $50,000 per year, you'll need $1.25 million. Or use the 4% rule. You can safely withdraw 4% per year from your investments. Sound impossible? It's not. And here's the best part. You don't have to do it alone. A confident, smiling person looking at their growing investment portfolio. Retirement isn't about age, it's about wealth. And wealth isn't about luck, it's about strategy. Now that you know how to structure your investments, don't let this knowledge go to waste. Start today. Automate your investments, build your asset allocation, and secure your future while you still have time on your side. If you found this valuable, hit that like button, subscribe for more smart money strategies, and comment below. What's your biggest financial goal for retirement? See you in the next video.